Hello and welcome to this video lesson on the topic profits and gains of business and profession. This lesson pertains to the course Income Tax 1 from the 5th semester of the 3-year BCom UG program offered by Dr. B.R. Ambedkar Open University. In this lesson, you will specifically learn on what basis income is computed under this head. You will also understand the general rules of admissibility and also get familiar with special terms that are used in this particular head, under this particular head of income, and also know the chargeability under section 28. Now, this particular head, the sections are from section 28 to section 44, and in this lesson you will know the chargeability under section 28, and also you will understand the guiding principles upon which the income from business and profession is computed. As we go into the lesson, now this particular head is very important because this is the third head of income. You all know that under the Income Tax Act, there are 5 heads of income. The first head is income from salary, second head income from house property, third head is income from business and profession that we are now discussing. The fourth head is income from capital gains, and the residuary head, the last head, is income from other sources. So, we are going to deal with the third head of income, which is income from business or profession. Now, this section or this head is very important because almost 70% of the total revenue from direct taxes is from this head of income only. And moreover, there is more scope for manipulation under this head. As we go into the lesson, you will know how this manipulation is done by unscrupulous assessees in case if there are any. In order to know what these kinds of manipulations will be and how to reduce or eliminate them, we have to understand how to compute income from business or profession. So, that is the importance of this particular unit. Now, first we said under the learning outcomes, you will know on what basis the income is computed. Now, as you all know that in a business, the business will maintain what is known as a profit and loss account. The profit and loss account is an account prepared at the end of the year by a business enterprise. In this profit and loss account, there are various items that are debited to the profit and loss account. They are known as items of expenditure. Items of expenditure are debited, items of income are credited to the profit and loss account. And one important item of expenditure, or rather an item that is debited to the profit and loss account, is depreciation. And depreciation is charged by the owners as per a method that is convenient to them. There are different methods of charging depreciation. It may be charged on a straight line basis, it may be charged on the diminishing balance method, or it may be an annuity method or sinking fund method. The choice of the method is left to the assessee, left to the businessman. But however, the Income Tax Act has prescribed rules for charging depreciation, because if you know, depreciation is a charge on the profits. If you allow depreciation to be debited to the profit and loss account, your profits will reduce. If you don't allow that to be debited, your profit will increase. So, increase or decrease of profit invariably will lead to increase and decrease of income. And when income decreases, the consequent tax that you pay also will decrease. So, therefore, unscrupulous businessmen may tinker with depreciation. So that is why the Income Tax Act says that depreciation has to be charged as per section 32 of the Income Tax Act. Okay, and we will give a small example here, an example to show how profits can be manipulated by the business enterprises. Suppose a business has developed a publicity film in a year. The cost of this publicity film is assumed to be rupees 5 lakh. If the firm debits this in the profit and loss account, the profit will reduce by rupees 5 lakhs. It is free to debit, or it can treat this as a capital expenditure and take it as an asset, because the benefit of this publicity film will be available to the business for more than one accounting year, for more than say 2 or 3 years. It can spread this expenditure over 3 years or debit it in the initial year itself. If it debits it in the initial year, the profit will reduce, the tax also will reduce. So therefore, there are many items of debits which will give ample scope for the businessman to reduce his profit. So we should know what are the items that are allowed to be debited by the Income Tax Act. What are the items of income that are allowed to be credited as per the Income Tax Act. That is why you should know on what basis the income is computed under this head, because you have to arrive at the fair profit. Okay. Now, what is fair profit? The profit disclosed by the profit and loss account is as per the accounting concepts and conventions, but we have to calculate profit as per Income Tax Act, which the Income Tax Act says is a fair profit, a profit that is representative of the actual state of affairs in the business. And also you have to know the rules for charging depreciation, because as we discussed, depreciation being a charge on the profit, it will either increase or decrease the profits disproportionately. So therefore, you have to be aware of the rules for charging depreciation so that you arrive at the fair profit. The Income Tax Act just simply states as a general rule that any expenditure that is incurred in the course of business and for business expediency is permitted. Now you might understand, or you might get a doubt, what is the usual course of business? Suppose I am engaging in the manufacture of, say, electronic equipment. My usual course of business would be the business of purchasing raw material used in an electronic business, say mobile phones. What kind of raw materials are purchased, what kind of expenditures are generally incurred would be the expenditure in the usual course of business. Suppose I purchase, say, land and show this as my usual course of business. Will it be allowed? It will not be allowed, because it is not in the usual course of business. And another thing, the expenditure has to be for the purpose of business expediency, that is, for the benefit of the business, for the betterment of the business, for the expansion of the business, and for the ultimate use and good of the business, the expenditure has to be incurred. This is the general rule, and incomes directly related to business only will be allowed to be credited. So this is the general rule, that this rule always you have to keep at the back of your mind whenever you are treating any item of expenditure as allowable under the Income Tax Act. Items that are debited, you have to check whether that item that is debited in the profit and loss account is for the good of the business, is prudent, is for the benefit of the business, is for business expediency or not. That you have to keep in mind. That is the general rule. Now, as we were saying, that you will also know the terms that are used in this particular head of income. We will discuss, see, our topic is profits and gains of business and profession. What is business? Business is defined under section 2 subsection 13 of the Act as any trade, commerce or manufacture or adventure in the nature of trade, commerce or manufacture. Okay. So, anything that is in the nature of trade. Trade means exchanging goods and services for value. Value for a business is money. Any commerce. Commerce include industry and aids to trade. Any manufacture. Manufacture is a process where you convert raw materials into finished goods. In the process of conversion, what all are included are termed as business. So, if you look at this section, that is 2 subsection 13, business is a very wide term. Anything under the sun can be included as business. But however, that particular activity should be engaged into with the intention of earning profits. It should not be for leisure. It should not be for pleasure. It should not be a vocational activity. It has to be an activity undertaken with the objective of earning profits out of that activity. Okay. So, it may be any occupation that is continuously carried out for the purpose of earning profit can be termed as business. Then we said profession. What do you mean by profession? Profession means any kind of occupation that requires intellectual skill or manual skill of the person involving in that occupation. Suppose a doctor. You cannot say a doctor is in business. You cannot say a painter is in business. You cannot say a sculptor is doing business, because they are using the skill they have acquired and earning gains out of it. That is why we said profits and gains of business or profession. For a business, you get profit. For a profession, you get gain. That is the difference between business and profession. While profession requires intellectual abilities, business does not require much intellectual ability. The basic difference here is business can be carried on by the SSC, by himself or through an agent, while profession has to be carried on by the SSC himself. A doctor cannot say that instead of me, my wife is going to treat the patient. Instead of me, my son is going to treat the patient. A sculptor cannot say, a painter cannot say, instead of me, my son will paint. But in a businessman can say, instead of me, my son will do the business. Okay. See the difference between business and profession. With business, you get profits. With profession, you get gains. Both of these are dealt with under this head, profits and gains of business or profession. Then coming to chargeability under section 28. What is chargeability? Chargeability means the basis on which the income is charged to tax. The income is charged to tax. And If you have to charge any income that is derived from business and you have to tax it, the income has to be earned from business that is run during the previous year. Because the general rule is incomes earned in the previous year are taxed in the assessment year. When you are taxing the income from business, that business has to run during the previous year. The business has to be actually run during the previous year. Here it is not necessary that the business has to be run throughout the year. No. The business may be run for a part of the year or throughout the year, does not make any difference. But it has to run during the previous year. And run by whom? Run by the assessee. The business has to be operated by the assessee. These two things will determine the chargeability under section 28. Then, along with income from business, compensation also is taxable as income from business. What is compensation? When you compensate somebody for a loss that they are incurring due to any action of yours, that is called compensation. That is, you are making good the loss as far as money can do it, to the extent money can do it. We will take an example here. Suppose a person has got a managing agency with Hindustan Petroleum Limited, we will assume. HPCL gives him a commission of 10%. If HPCL enters into a contract with him saying that henceforth your commission will be reduced to 8%, and because of the loss that you might incur, we will pay you a lump sum of say 5 lakhs. This lump sum of 5 lakhs is called compensation. Why it is paid? Due to loss that you might incur because of the change in terms of contract. That compensation is taxable as income from business. Compensation received by termination of agency or compensation received from the government for any activity that you have given up in favor of the government. So, any kind of compensation also is chargeable under section 28. Then income from trade associations. Now, you all know that there are different trade associations who in which the members are the traders. Suppose Abbott's Cloth Merchants Association, Jewelers Association, Chambers of Commerce. Now, all these people, they come together, form an association to protect their interests. If you have to be a part of the association, you have to pay what is called as membership fee, which is known as subscription. Subscription received by the association or subscription paid by the members, we are not talking about that. But however, if this association gives some services to its members and charges some amount to the members, then that is the income of the association. That income is taxable under section 28 subsection 3. Along with that, some self-explanatory things like profit on sale of license, cash assistance, refund of duty, benefit arising from business. That is, what is the meaning of benefit arising from business? They are known as perquisites or perks. Those perquisites are taxable under income from business or amount that is received by a partner by way of remuneration. Another important thing which is charged as income from business is profit from speculation. Here we will have to understand what is the meaning of speculation. Speculation is a transaction in which there is a contract for sale or purchase of a commodity or a script which does not involve the actual delivery of the scripts. Okay. So, where the actual delivery is not there, that is known as a perquisite. We will give an example here. Suppose A enters into a contract with B saying that he is going to buy 100 bags of sugar at 10,000 rupees after 2 months. He is going to buy 100 bags of sugar at the rate of 10,000 rupees for all those 100 bags, but this sale or this purchase is going to happen after 2 months. Now, after 2 months, the price of sugar is not 10,000 but 12,000. When the contract was made, the price was 10. When the contract has to be honored, it is 12. Now, here instead of actually buying the sugar, he will only pay the difference. The seller will only pay the difference of 2,000. Here there is no actual delivery or sale of the bags of sugar, but only the difference in prices are traded. This is called speculation. Okay. So, speculation has to be treated as a separate business altogether. Any income derived from speculation is taxable under this head, however. Okay. But if there is any loss due to speculation, that cannot be set off, cannot be deducted from a non-speculation activity. So, that you have to remember. Speculation profits are taxed, speculation losses cannot be set off from non-speculation. They can be set off from a similar speculation activity, but not from non-speculative activities. Then profits earned from illegal business. Now, you might be surprised whenever you say illegal business, you will sit up and then pay attention. If the business is illegal, should the businessman pay tax on it? The Income Tax Act does not make any distinction between legal or illegal business. But if a person earns any profit from an illegal business, he has to pay tax on that profit. The Income Tax Act will not go into legality or illegality of the business. It is only concerned with the tax that has to be paid on the profits that are earned. Whether you earn the profit legally or illegally is not the botheration of the Income Tax Department. So, you have to pay tax even on illegal businesses. Okay. But however, any expenditure earned to earn an illegal income cannot be deducted from a legal income. Okay. It cannot be deducted from a legal income. So, here Income Tax Act will tax the illegal income, but expenditure incurred to earn that illegal income will not be allowed to be deducted from a legal income. That we have to remember. So, there are certain guiding principles that have to be kept in mind when you are arriving at the business income. See, we are carefully using the term business income because profits and gains of business or profession is known as business income, while the net profit that is to be used to arrive at business income is as per the Companies Act. So, you have to take the net profit as per Companies Act and then apply the principles of Income Tax Act, the guiding principles, arrive at business income and put tax on that business income so arrived at. So, therefore, there are certain things that you have to keep in mind. Any business or profession has to be carried on by the SSC that we have discussed, and it has to be carried on during the previous year. Carried on means not actually carrying on. The right to carry on the business should vest with the SSC. The SSC should have the right to carry on business. He may carry on the business by himself or through an agent, that is immaterial, but the right to carry on should be there with the SSC. Then second, aggregate business income is taxable. Suppose the SSC has got 4 or 5 businesses. You will compute the income for each of the business separately and calculate tax on the total of the incomes. That is known as aggregated income. But here you have to remember, whatever expenditure is incurred to earn the income will be allowed to be deducted only from that income. You cannot crisscross the expenses. If SSC has got an income business in Hyderabad and another business in Mumbai, expenditure incurred to earn the business in Hyderabad will be deducted only from the business income of Hyderabad, and expenditure incurred to earn the income in Mumbai will be deducted only from the business profits of Mumbai and not vice versa. However, the total income arrived at has to be aggregated and tax has to be levied on the total, not individual. That is what this point says. Then speculation, as we already discussed, has to be a separate business activity, not to be clubbed with non-speculation, and tax is levied on the real owner. Real owner means the beneficial owner. Okay, sometimes what happens, you will have benami transactions or benamdars who are holding the business, in whose name the business is run. In such situations, they are not the real owners because they do not enjoy the profits. They have to earn the profit, give it back to the real owner. So it is the real owner who is supposed to pay tax, but not these owners on paper. Okay, so the real owners only will be required to pay the tax, and tax is on real profit but not on notional profit. Okay, real profits mean the actual profits. What is a notional profit? A profit that is assumed is a notional profit. It is an assumed profit but not a real profit. So tax has to be levied only on real profits, and admissibility of deduction is based on the existing liability. It should not be a future liability. A classic example here is bad debts. Bad debts are actual, while provision for bad debt is a probable expenditure, a probable loss. Okay, so it is only actual but not probables. The loss has to be incidental to the business. The onus of proving the loss has to be on the owner, and even a single transaction is taxable. If you look at these items in detail, existing liability means liability that exists at the time of preparation of the profit and loss account, and the expenditure has to be for the benefit of the business, and the loss has to be incidental to the business. The onus of proving that the expenditure is for the benefit of the business lies on the SSC, lies on the businessman, and a transaction may be a single transaction. It is not necessary that the business should have a series of transactions. Even a single transaction might result in a profit. That profit is taxable. So these are the general rules that you have to keep in mind when you actually try to calculate income from business or profession. So we take the net profit, apply all these principles, decide each item of debit whether it is allowed or not. If it is not allowed, remove that item of debit. What you get finally is called income from business or profession. Okay, so these are the theoretical aspects of how to calculate income from business or profession. I hope this lesson was useful. Thank you.